Should you be buying growth stocks right now? That's the question a lot of folks are asking themselves as they've seen their favorite growth stocks hammered over the last few months from the February 2021 peak. Several growth stocks down 40, 50, 60%. In some cases, some of the speculative SPACs are down even more. If you look at the ARK growth ETFs, the innovation ETFs, they themselves have a similar trajectory over the last few months where from peak to trough, they declined about 40%. They've started recovering a little bit since then. So folks are asking themselves, look, growth, innovation, this should do well over time. Is now the time to be buying growth stocks? Is now the time to be buying the Cathie ARK ETFs? Because is this the dip in growth stocks that historically over the last 5-10 years would have been a great buying opportunity? Is now the time to be buying? Is this the bargains? And so thinking about that, and also thinking about my prior experience working on Wall Street, whether or not in investment banking or multi-billion-dollar hedge fund, I think I do have some insights here that might be valuable for your own personal investment journey as you size up whether or not you want to buy growth stocks. That said, I'm not going to tell you what you should do on your journey. What I am going to share is what I suspect the billion-dollar hedge funds are doing right now, what they're considering, just seeing it from their perspective. What are the billion-dollar hedge funds considering right now? And then at the end, I'm going to share what I think I'm going to do and what I'm doing actively right now. So what are let's say, the global macro hedge funds, the multi-billion-dollar hedge funds doing in this environment? So they, first of all, they play a different game than a lot of, than the retail investors. They're not necessarily looking at individual stocks. A lot of these global macro funds, what they're looking at is liquidity. They're tracking liquidity. What is the Federal Reserve going to do? And they do this country by country, saying, is it tight monetary conditions? Is it loose? Are you printing a ton of money? Is inflation's rampant? What's going on with the currency? They're looking at all these different variables, and it's a completely different game, chess and checkers that's going on with some of these global macro hedge funds and what they're considering. And so when you think about liquidity, you got to look at the Federal Reserve, particularly in the United States. And the Federal Reserve has among its most aggressive policies that they've ever had, particularly for an economy like this, where arguably the economy is recovering. If you look at retail sales, it's above trend line. And then you see that they still have this very aggressive response, effectively fighting the last war, fighting what was COVID, a dramatic, pit where no one knew what the economy would look like. They still have wartime measures going on with over $100 billion in asset purchases each month. This is one of the most aggressive responses ever, and some could argue that it's actually driving bubble type behavior, and it's malinvestment and poor decision for the Federal Reserve to keep doing this. For example, a lot of people are saying, hey, I'm priced out of my home or potential homes in the market I'm interested in. They're seeing home prices jump, and wait a second, the Federal Reserve is still buying mortgage-backed securities to the tune of $40 billion a month. Does that make sense in this environment? Probably not. They probably are overheating the setup. And look, that's, if you study the history of central banking, this happens. They're not perfect. They make mistakes. And that's the reason why these global macro hedge funds are tracking liquidity. And so what do you think is going to happen? So they're looking at these different elements. They're thinking, okay, these treasury buyers, so the Federal Reserve's buying, let's say, these securities, and then the natural owners who would be buying them, they're going to buy something else. So they're moving along the risk curve, and they're buying equity securities. They end up buying stocks, and that, in all honesty, has been one of the key themes over the last better part of the decade of like, hey, if the Federal Reserve is going to buy hundreds of millions or hundreds of billions of dollars of securities, hey, you effectively should get this bid on stock prices. But what about inflation? You've seen inflation pop up. Even Buffett said inflation is here. People are worried. Well, wait a second. If inflation starts popping up, won't the Federal Reserve have to, scale back, and they won't have to have this massive money printing that effectively is happening right now? In their view, and so you need to understand, it's not what you think is appropriate right now. You need to see what are they doing, and what they're saying is, look, that inflation's transitory. They've effectively said we still have a green light to keep doing what we're doing to juice the economy. So effectively, negative real rates is what you're going to be experiencing, where inflation is outpacing what you could get with the interest bonds or with the interest rates that you could get. And so and keep in mind, these billion-dollar global macro hedge funds, this isn't all their money. This isn't all like the hedge fund, oh, he's just a rich, guy or gal, and it's their money that they're speculating on. usually what they do, especially with its hedge fund where you have this dramatic, 20% performance fee structure, at least for a lot of funds, is that they are playing with OPM, other people's money. So as long as the music's playing, they're going to, as Chuck Prince once said, the former CEO of Citi infamously said, as long as the music's playing, you got to keep dancing. That, I think, is what these global macro funds are going to do, is that, hey, as long, even if the Federal Reserve is going to have to reverse course at some point, potentially later this year, and call that out. For now, they're saying it's transitory. Let's squeeze our returns as much as we can. We're going to go all the way to the point where the Federal Reserve changes it. So you could potentially have things start getting bid up. So what I think is going to happen is I think these global macro hedge funds are going to trepidatiously start buying this dip in terms of growth stocks, buying the types of growth stocks that underlie the, let's say, the ARK ETFs, buying these things, saying, hey, the growth, the risk on play is still on, seeing that the Federal Reserve is still giving the green light, saying, hey, it's just transitory inflation. We're still going to have 100 billion plus, in asset purchases. We'll scale that out very slowly over time, and future rate hikes, we're still not even thinking about that. So until that language changes, then I think the game's being played, and you have these hedge funds stepping in. That's what I think is what's being considered right now. That said, they have their eyes like laser focused on, I'd argue, two things that could say, hey, this could bust the thesis. So this is the wait a second, if everyone's still dancing, recognizing that we're getting closer and closer to everything turning into pumpkins and mice, these are the things that could accelerate the clock. These are the things that turns everything into pumpkin and mice. And the two things I think that jump out are, one, if you see the long-term interest rates, treasury rates, start going higher, then you start having a problem. And one way to track that is the ETF TLT. You could see that Michael Burry, I did a video on this, he was betting against TLT, effectively saying, hey, I think rates are going higher. And so if rates are going higher, TLT is going lower. And so that is one way to do it, effectively saying, hey, this is not sustainable what we're doing. Rates go higher, which case revisit the thesis. That said, you look at, for example, the price action today where growth stocks got a bid. This is Thursday, May 20th, where they got a bid, and you also saw that TLT got a bid as well, and rates went lower. So that's something to consider, especially given that TLT and long-term treasury bonds are so oversold that it is possible you do get some sort of bounce there. So that is definitely something to consider. One is, what are long-term rates doing? Has the market reacted unfavorably yet? The second aspect is any change in the language from the Federal Reserve is going to put them at the edge of their seat saying, oh, okay, what is going to go on? So if the Federal Reserve says, you know what, I ate some spicy food for lunch today, I think I'm going to raise rates sooner, man, the market will capitulate. It'll be down 3% by the time he's had time to digest his burrito. And so that's the way this market is structured right now, particularly with the global macro funds looking at liquidity, where they're looking at, one, what are long-term rates doing, and two, any language, parsing out particular words from the Federal Reserve, where if they change their language about, oh, you know what, we're going to have to, pause that money printing that we're doing, that QE, we're going to have to stop that a little sooner than we expected. That's going to be the type of thing that everything's pumpkin and mice. That's mice time. When they say, you know what, we're going to have to revisit our schedule and we might have to raise rates. This is no longer transitory inflation. If you have something like that, that's going to be the type of thing that it's pumpkin time. The ball's over, the dance is over at that point. But at this point, given that these funds are playing with other people's money, and that's the way they look at it, where it's, hey, let's try to have a home run, and therefore we can make a ton of money for ourselves. It's let's play as long as the music's, let's dance as long as the music's playing. And that's sort of what's going on. What I suspect could start going on, especially we've had this sell-off over the last few months. Could this be? And you've sort of seen it with the Federal Reserve over the last few days. So not really, you haven't heard any real commentary saying like, oh man, we got to respond to this inflation. It's really been, you know what, that's transitory. Once there's a change in that language or interest rates, then I'd argue you got to revisit. That's what the global macro hedge funds are thinking about. Now keep in mind, that's not what you have to do. That's not what I'm personally doing. different investors need to consider different games. Not everyone's playing the same game. So what am I personally do? And so recognize some investors are doing it from the top down, so understanding liquidity around the world and where it's moving to. And other investors do bottoms up type of investing where you're looking at the individual securities and saying, hey, is this a good bargain? And then you sort of work your way up to saying, hey, is the market expensive or is it cheap? Well, what should I think about macro risks involved with the company? I personally try to take a bottoms up approach to this where I look at individual companies and say, hey, is this a good risk reward? Not, hey, I should be dancing right now. So as I look at this, given that I suspect the music to stop playing later this year, that's not driving my thesis with any of my stocks. Given that I suspect that that's going to happen though, I am a little more conservative than I normally would be with my stocks, saying, hey, I want a better risk reward with what I'm owning. And that's personally what I'm doing. But for every situation, it's, hey, could I make a compelling case that this has attractive risk reward, where I'm saying, hey, what's my downside? What's my upside? And as I want to get more conservative and I want to become more conservative with my personal portfolio, my downside, instead of, let's say, downside of negative 30%, I might say, you know what, I actually want 50% upside from my downside scenario. And I want 200% upside minimum for my upside scenario. And so that's how I start tweaking my own personal investment decisions, where it's saying, hey, how am I, what do I think is the true risk reward when I'm looking at these things? And one example of which is a stock that I personally bought and I own, and I've done a video on breaking down their current valuation, is Alibaba stock, BABA. You can also buy it directly on the Hong Kong exchange if you want to buy the ordinary shares. I also, not the ADRs, I also use hedging, which I talk about extensively with my Unrivaled Investing Journey subscribers. And if you also want to know more about my personal journey in terms of what I'm doing, go to unrivaledinvesting.com, and that's where I have a full profile. It's an exclusive thing just for the Unrivaled Nation that wants to track potential multi-baggers each month, calling out a new idea, as well as my personal holdings during the first week of the month, going over what's my portfolio build out. And we're also building a dedicated community of like-minded investors in Discord where we can share thoughts, and that's more real-time updating that I do over there in that Discord community. So if you enjoyed this video talking about sort of should you be considering buying growth stocks right now, and what are the global macro hedge funds doing, what are they doing, what are they considering, what are the implications for growth stocks, growth ETFs like the ARK ETFs, please make a point of subscribing. If you're already a subscriber, I do appreciate the thumbs up. Thanks so much for watching.